If you're a sports fan, you know that there's often a difference between a player's stats, how they look on paper, versus what you see when they're out on the court or the field. The stats, they can be a little misleading. Well, it's the same with the economics under President Trump. On paper, his economy doing gangbusters. New data out today, it shows the nation added 164,000 new jobs just last month, with the unemployment rate holding steady at 3.7%. Wages, they're even rising, up more than 3% last month compared to the year prior. Now, the president's pressure campaign on the Federal Reserve, it also paid off kind of. Trump got the rate cut he wanted this week from Chairman Powell, which almost always means a shot in the arm for the economy. But Wall Street, they've been selling off rather than buying. Down Wednesday, the day of the rate cut, down again yesterday, and down again today. Well, the logical question would be why? Well, it's in part because of worries that the Fed won't be able to respond with more rate cuts if in fact the economy goes south. Investors, they're also concerned about China and the escalating trade war. After Trump threatened more tariffs this week and trade talks with China appeared to stall. Now, just like Mexico paying for his border wall, the president continuing to mislead Americans as to who actually pays for those tariffs.
You're not paying for those tariffs. China's paying for those tariffs.
Well, economists and just about any other expert routinely knock this down as just a flat-out lie. Americans, of course, pay the tariffs as an extra tax, and they're also hammering them for that Fed rate cut, including New York Times contributor Ruchir Sharma, who is the head of emerging markets for Morgan Stanley Investment Company. He penned a column about the Fed titled, "Why We Should Fear Easy Money. Cutting interest rates now could set the stage for a collapse in the financial markets." And for more, we're now joined by Ruchir Sharma. And first of all, thanks for a few minutes. And explain to our audience, in your view, this uncertainty in the markets and certainly a down day today. How much do you attribute that to an escalating trade war with China versus a rate cut that isn't what the president expected or not seemingly what the markets did either?
Well, I think that the reaction that you're getting today is overwhelmingly about what's happening on the trade front. And we saw that yesterday as well, which is that the market, in fact, started to stage a comeback after the sort of disappointment it faced on Wednesday afternoon when Powell did not deliver as much as they were looking for. But the moment the trade news came up about the tariffs, the market sold off instantly after that. So what's happening the last couple of days is overwhelmingly about the renewed trade war threat.
You know, let me bring it back to what Powell chose to do. There was a lot of feeling by some that, you know, basically the Fed, the window's open. You can almost borrow money for free for all intents and purposes. Why was he talking about a rate cut anyway? It's one of those tools that when we have a recession, like we'll always have a recession at some point, it's one of the few tools in the toolbox that they have to at least try and get money back going into the economy. Were you surprised that Powell reduced the rates at all? And was it wise to make it such a modest reduction instead of maybe what the president and others were clamoring for?
No, as I argued in my New York Times op-ed earlier this week, which is that I didn't think that the case was justified for a rate cut at all. Because, yes, in the near term, we have seen some economic weakness, particularly across the world. But you've got to step back and look at the bigger picture, which is this, that the real interest rate, which is the interest rate in the United States subtracted for the rate of inflation, is close to 0.5%. That's at the low end of its historical range, very low, in fact, by recent historical standards. So money is literally free in the US. And I didn't think that given how the economy is doing, we needed a further rate cut at this point in time, particularly because of the financial stability risks that poses. The stock market is close to record highs, is trading at very expensive valuations, bar for the 99-2000 bubble. In fact, it's the most expensive the US stock market has traded in. And generally, the financial economy has become so big that it poses a risk to the real economy. And throwing more easy money at it juices up the financial economy more than the real economy. So that is why I thought that a rate cut at this stage wasn't even that justified.
You also said in your piece that in many ways, given how expensive the market is, you're almost encouraging people to increase personal debt. And it seems as if, hey, maybe in the aftermath of 2008, that might have made some sense. But right now, especially with the economy doing how well that it is, I don't know. It seems like we might have forgotten some lessons that we've learned time and time again through our history.
That's very true. And I think that the central bank, even here and across the world, are very focused on the classic measure of inflation, which is to see how much a consumer price is going up. And if it's not going up by their sort of target of 2%, they think that they need to do more to somehow get it to 2%. But I think that what we forget is this, that in the modern economy, it's not consumer prices which are the cause of trouble, but it is when you get too much asset price inflation, or when financial assets like stocks and bonds become too expensive, because when they fall, they drag the economy down. Today, the size of the financial economy is 3 times the size of the real economy. So the tail has begun to wag the dog in a way. So yes, I agree with you, which is the fact that using stimulus to try and prop the economy when things are really down makes sense. But at this stage of the economic cycle, the bigger risk you pose with such rate cuts is to the financial stability, and that is something which I was warning about in my piece as well.
Let's pivot to China, and I think that there was a rational case to be made for this incoming president that our economic relationship wasn't based on equity with China and something needed to be done. But I haven't found a person that's not in the bag that can give any rhyme or reason to a rational, strategic play that's going on right now. It seems that there's emotion, and then there's consequence, and then the strategy will come at the end of it. Am I missing three-dimensional chess here? But it seems to be haphazard as best.
Yeah, in terms of the way that it's playing out on a daily basis, it absolutely appears that way. But again, if we sort of look at the big picture here, I think that one thing we can be a bit sort of comforted by is the fact that there's a lot of bipartisan consensus on this one issue, which is to do with China. In this country, there's so much polarization today that there are very, very few issues on which both the sides agree on. But as far as China is concerned and the policy on China, I think on that we're getting an increasing amount of bipartisan support. President Trump may be more aggressive about it, and his tactics may be sort of very haphazard in terms of, like, all of a sudden you get an announcement of a tariff, and it's quite likely that 3 weeks later, at the slightest excuse, there's some sort of a deal which comes up. So that, I think, is problematic. But in general, I think the good news, at least on this front, from a purely American perspective, is that you're beginning to get a lot of bipartisan support when it comes to the fact that people here are getting more united, that something needs to be done as far as China is concerned.
Finally, part of what you do is you forecast. Where do you think we're going to be a year from now? I mean, the economic numbers, the job numbers that have just come out here have been terrific. Even wages have been going up in a perceptible way. That said, we're 2020, August, first week of August. Do you foresee an environment that the economy is continuing to grow quarter by quarter like we are? Or do you share the pessimism of some here that we could be in the middle of a downturn?
Possibly the economy will be weaker than where we are now, but to forecast a recession, there's nothing which is out here currently for me to forecast a recession or a big downturn 12 months from now. I think the biggest source of worry for me is what's happening globally, that the weakness in Europe, in China, where I'm going next week, in fact, I think that those are the places I'm more concerned about, that some of that international weakness sort of spills over here to the United States. And to the extent that if asset prices keep going up, that, like, they fall under their own weight at some point in time, that's the other risk I see. So the cycle is getting pretty long in the tooth. It's getting more vulnerable. But I wouldn't bet on just a downturn because of the fact that we're in the 11th year or something. I mean, age by itself is not enough of a predictive, sort of indicator.
Ms. Sharma, appreciate the time. Thank you so much. Coming up next, everybody, there are about 24 Democrats that want to be president. We've seen that on the stage in Detroit, all equally committed to defeating Donald Trump. So the question is, why are so many Democrats now taking aim at President Obama and his record instead? And do they risk alienating Democratic voters who still revere the former president? We'll get into that straight ahead.